Good evening, good afternoon, and good morning, everyone, depending on which time zone you're in. My name is Rupam Deb, and I'm the co-founder of MoneyWiseSmart. My business partner and co-founder Fan Liang Chia and I would like to extend a very warm welcome to all of you to this knowledge series discussion session from MoneyWiseSmart. And we promise you that you will derive a lot of value from this session. Today, we are delighted to host Saurabh Mukherjea as our guest speaker. Saurabh really needs no introduction, but I'll introduce him anyway. He's the founder and chief investment officer of Marcellus Investment Managers. His consistent compounders portfolio outperformed the index by 9.6% compounded since inception as of 31st December. So that's really an amazing performance. Saurabh was the co-founder of Clear Capital in London, and in 2007, he was rated by the Excel survey as one of the top small cap analysts in the UK. He was rated as the leading equity strategist in 2015, 16, and 17 by Asia Money polls in India. And prior to setting up Marcellus, Saurabh was the CEO of Ambit Capital. He has written several best-selling books, some of my favorite books: Gurus of Chaos in 2014, The Unusual Billionaires 2016, Coffee Can Investing, The Low-Risk Road to Stupendous Wealth in 2018, The Victory Project, 6 Steps to Peak Potential, 2020, and Diamonds in the Dust. That's, I think, his latest book, Consistent Compounding for Extraordinary Wealth Creation. Saurabh was educated at the London School of Economics, where he earned his BSc in Economics with first-class honors and MSc in Economics with distinction in macro and microeconomics. Now, after Saurabh's session, we are going to have Q&A session. So please keep your questions ready in the chat, and I'll be moderating the questions. And during the Q&A, we will also be having an exciting quiz session. So keep your quizzing hats and fast fingers ready, because there are going to be attractive prizes to be won. As the MoneyWiseSmart quizzes have always been very popular. So you guys have been asking us to bring it back. So we have some exciting questions, and this book is going to be one of the prizes. This is one of my favorite books. After having read several hundred investment books, I can safely say this ranks right at the very top. Maybe you might be able to relate to the Mr. Talwar in this book, even though this book has been written in an Indian context, but I think it's relevant for everybody around the world. So without further ado, over to Saurabh. Saurabh, take it away.
Thank you very much, Rupam. Thank you very much, MoneyWiseSmart, for inviting me, and look forward to those prizes. It'll be helpful if I could also participate. I'm also getting quite.
No, you're the judge. You're not allowed to participate. That will be an arbitrage.
So can you invite me to a future session when I can participate?
Oh, definitely, yeah.
So I'll take you guys through what we do in Marcellus. I'll give you a little bit of background on us as well, so that it puts it in a human context. Otherwise, it will make it feel very robotic. So there's 3 of us. We've been working together now for 18 years. 2004 is when we started working together. In London, I set up a company called Clear Capital with a few friends, and we used to advise British families on their investments in the London Stock Exchange. We became quite well known for that. Jan 07, we figured out that the British financial system is going to blow up. So all of 07 was spent sitting down with our 200 or so clients, explaining to them why the largest banks in the UK were going to blow up. We gave them fairly detailed research on how the balance sheets of the largest lenders in the UK were going to blow up from Jan through to September. I remember doing hundreds of meetings like this. Early 08, we realized that not just the UK, but also the United States is also going to blow up. And that's when we decided to sell Clear Capital. We were very fortunate because we had moved early. We decided to sell early. One of the largest banks in Europe agreed to buy us. May 2008, after selling the company and getting paid for selling the company, we migrated to India. That was 14 years ago. We migrated to the city of Mumbai. We didn't know a soul in Mumbai at that point, 14 years ago. So because we didn't know anybody, we just locked ourselves in a small office in the suburbs of Mumbai and started reading. We started reading the financial statements of the largest Indian companies. As you can see from our profiles, we are chartered financial analysts. So we knew the only thing we knew how to do, and we were new to India, is read annual reports. And as we read the annual reports of the largest Indian companies, this is 14 years ago I'm talking to you about. As we read the annual reports of the largest Indian companies, we realized that the vast majority of India's large companies, numbers actually, the published financial statements is actually a sham, right? And And what's the easiest way for you and I to figure out whether it's a Indian company or a Chinese company or a Venezuelan company? What's the easiest way for us to figure out that the numbers are a sham? Is to look at the cash flow statement, right? So I remember back then, and actually it's true even today. If you look at the largest companies in India, many of the largest companies in India, you'll see over the last 3 years, 5 years, 10 years, 15 years, these companies have generated no free cash flow. And these are well-known companies. Their owners tend to be the people who basically run India. These people are very high-profile people. They're making Bollywood movies. They're running some of the highest-profile sports teams in the countries. They have residences in Singapore, Dubai, London. But if you look at their businesses' cash flow statements, the businesses make zilch money, no money at all, no free cash flow at all, right? So this intrigued us. This intrigued us that these people who are these promoters, as we call them, promoters are owners. These owners who are living it up, they're living the high life, but the business makes no money. So what we did for our first couple of years in India, 2009, 2010, we basically went and met these people. So one by one, every week we would choose one such naughty company where the annual report was not passing muster by us. And then we would write to them saying, look, we've read your annual report. We have questions about page 69, page 102, page 132. And typically they would basically get really panicked when they would read our emails, because they would figure out that we had figured out that they were doing naughty things. So they would grant us an audience, and we would spend that meeting discussing how many different ways these companies are stealing money. And to give these promoters, these owners, a lot of credit. I mean, today many of these people are in jail. They're in prison today, but back in 2009, 2010, these were very high-profile people. Today, they're either in jail today or they've run away from India. They're sort of living in London or the West Indies or some such place where they're trying to escape the Indian legal authorities. But back in 2009, 10, they were very powerful, very famous, very wealthy people. And to give them credit, their point to us was that, look, Saurabh, you guys are new to India. That's why you think we are stealing money in 3 places. Actually, we're stealing money in 6 different places, right? And they actually helped us. They trained us in how India's most powerful companies steal money from domestic investors, foreign investors, the government, banks, and so on, right? So with their help, we created this forensic framework that you can see in front of you. It's very similar to a medical checkup, right? So when you go for a medical checkup, your blood pressure is tested, your triglycerides are measured, and so on, and there's a reference range, and if you fall outside the reference range, the medical checkup says that Saurabh or Rupam need to visit their GP because their triglycerides or their blood pressure, etc., is too high. Very similar to that is our forensic process. So we have these 12 forensic ratios. So we measure each company. In the month of December, we take the last 6 years of published financial statements on each company, and we look back at the preceding 6 years. And we compare a company to its peer group and to its own past and see if they're failing on those ratios. So just to take a very simple example, if you take this, right, one of the simplest and most interesting forensic ratios, which is growth in auditors' compensation divided by growth in revenues. So I think anywhere in the world, not just in India, I think anywhere in the world, if you find a company whose auditors' compensation is consistently growing faster than revenues, that's a pretty simple indication that the auditor is being bribed to fabricate the financial statements. And I've done forensics in the UK as well. When I used to live there, there's reasonable amount of fraud there as well. It's less, but I don't think either the British or the American or indeed the Chinese stock market is without fraud. And one of the simplest indications tends to be if the auditor is getting paid a lot of money, right? A more classical fraud test, which has been used across the world very successfully, and in a way this is the sort of the bread and butter of forensic scientists the world over, is CFO to EBITDA, operating cash flow to operating profit. This is called the cash conversion ratio. So for every 100 rupees of operating profit, how much operating cash flow does the company generate, right? So if you and I know the working capital cycle of an industry, we should be able to figure out at what rate should operating profit become cash flow. And if we see that the actual cash conversion rate is south of that, is below that, that's telling you and me that this company is doing something naughty. So for example, as we speak, one of India's largest pharma companies is doing very naughty accounting. I think in the next few years, they're going to blow up. How do we know that? Because we can see for the last 10 years, they've been making up the numbers on their P&L. How do we know that they're making up the numbers? Because their cash conversion ratio is 65%. For every 100 rupees of operating profit, they're generating just 65 rupees of operating cash flow. In reality, they should be doing around 85 rupees on every 100 rupees of operating profit. And that means that they're stealing money out of every 100 rupees of operating cash flow. They're stealing 20 rupees. We know where we think we know where that money is going. Basically, it's being used to finance the promoter's real estate business, which is unlisted, which is owned personally by him. And some stage in the next 2-3 years, as and when interest rates rise by say 2-3%, this company will go bust. The promoter will run away to London, and that's when everybody will say, "Oh, how are we supposed to know that?" And the answer is, well, if you read the annual report, you can figure out fraud. If you don't read the annual report, you're just like anybody else trying to make money. So what this process does. And in Diamonds in the Dust, folks, if you guys are interested in this, and if I understand the folks from MoneyWiseSmart correctly, you guys are trying to become investors, or you already are investors. If you are interested in investing, just first thing to do is learn to read annual reports really, really proficiently, because that's the bread and butter of investing. The bread and butter of investing is not reading the Financial Times or the Wall Street Journal cover to cover. That's not going to take you very far. What's going to take you very far is reading annual reports inside out, backside forward, in your sleep and in your daytime. And if you don't do that, as we do in India, you realize that half the stock market in India is a sham, right? Now, maybe the country you live in, maybe it's less than half, maybe it's more than half, but by and large, the world over, a significant proportion of listed entities are making the numbers up. And the first job of an investor is to scratch these companies out, right? So if you do that in India, which that's roughly half the market taken out of the picture. That's step one for our process, right? Step one is figure out whether the company's numbers are legitimate or not. Second step then is, amongst the companies who are legitimate, right? Amongst the companies who are legitimate, you and I need to figure out which of these companies actually has a capable management team, right? How do we know whether a management team is capable or incompetent, right? There has to be a simple way to assess, is the company's management team competent or incompetent? Because after all, even if the numbers are clean, but the owner, the management is incompetent, you and I shouldn't really be wasting our time looking at that company. So the simplest way we realized after 3-4 years in India is to look at return on capital relative to the cost of capital, right? So if a company is competent, if the management is competent, return on capital should consistently be above cost of capital, say over a 10-year cycle, right? And if you assume that in India, cost of capital is roughly 15%, right? The Indian 10-year bond yield is 7%, take an equity risk premium of 7-8%. Cost of capital in India, therefore, is 15%. What you and I are looking for, what we're looking for is companies whose return on capital is at least 15% over a 10-year period, right? What do we mean by return on capital? Return on capital in simple terms is operating profit, EBITDA, not DA, EBITDA divided by fixed assets plus working capital plus cash in bank, right? We need to see that number at 15% consistently over a 10-year period. And if we did nothing else in India, we just applied step one, forensic, step two, a 15% ROC threshold, you'll be able to invest in companies. There's only around 40 companies who pass this threshold. You'll be able to invest in these companies. You'll compound at around 25% in rupee terms and around 20% in US dollar terms, which is significantly ahead. As Rupam said very kindly at the beginning of the presentation, we compound around 8-9% faster than the index. Honestly, a lot of that is simply this process. Step one, accounting. Step two, return on capital in excess of cost of capital. And you get around 40 stocks which do that, right? So that's the first two steps. Straightforward stuff laid out for you in our various books, most recently in the book that we published last year, Diamonds in the Dust. Now, for the first few years in India, this is all that we would do, right? Then around 2016, 2017, we noticed something which gave us another layer of returns, right? What we noticed in around 2016, 2017 is that what's happening in India is the country is getting polarized. Broadly speaking, 20 companies are making pretty much all the profits in the country, or at least 80% of the country's profits are coming from just 20 companies. There are 6,000 companies listed in the country, but just 20 companies are making 80% of the country's profits. And we were very curious to understand this more. So this chart will tell you how this process has evolved, right? So in the early 90s, the Indian economy got opened up. So the country liberalized, as we call it. It opened up to foreign investors, to foreign trade. At that point, the top 20 companies in India used to account for a mere 15% of the country's profits, right? Early 90s, 15%. Around the time my colleagues and I came to India, the top 20 companies accounted for around 30% of the country's profits. Just before COVID, the top 20 companies accounted for around 60% of the country's profits. And today, sort of after COVID, fingers crossed, sort of after COVID, the top 20 companies account for 80% of the nation's profits, right? 20 companies 20 giant companies now make 80% of the country's profits. Even more fascinatingly, these 20 companies' profits consistently grow at around 20-25%, right? Profit growth for these companies is consistently 20-25%. And because overall profit growth in India is barely 10%, these 20 companies' profit share has zipped up into the sky, right? Right. So this is the sort of simple dynamic we spotted in 2016, and we became very curious about this. Why is it that these 20 giant companies such as TCS, HDFC Bank, Kotak Bank, Nestle, Asian Paints, companies in which we have invested billion dollar plus actually, how come these companies are consistently growing their profits regardless of whether the economic growth is 2% or 8%, right? And at a superficial level, the answer is easy to give. So let's do the superficial answer, then we'll go a little deeper into the subject. The superficial answer is the table on the right, right? What we are seeing in India, and this is, I'm sure you see this in the countries you are living in as well, but what we are increasingly seeing in India is in pretty much any sector, the top two players are taking away 80-90% of the profits, right? Pretty much any sector, the top two players are taking away 80-90% of the profits. So for example, just to use a very simple example, if I go to the supermarket near our office in Mumbai, the entire luxury biscuit market is dominated by one company. It's called Britannia, right? The entire luxury market is theirs. In fact, they have one biscuit called Good Day, which accounts for around 55% of their profits. Our math suggests that the return on capital on Good Day biscuit would be around 70%, right? Making it one of the world's most profitable cookies. And if I stay with the same supermarket near our office in Bombay, the affordable, the mass market biscuit is made by this one company called Parle, right? So Britannia plus Parle is nearly 85% of the biscuit industry profits. And one company is premium monopoly, the other is a mass market monopoly. They do not fight with each other. And as a result, if you add up the owners' wealth, the two families, the Wadias own Britannia, the Chauhans own Parle, if you add it up, these families are together worth $10 billion, right? Similarly, the paint industry is dominated by two companies. If you add up the promoters' wealth, they're worth $30 billion, right? You'll notice in the press these days, there's a lot of hoo-ha about Russian oligarchs, right? Those poor fellows, their wealth is nothing compared to the owners of these companies, right? These companies' owners are worth in excess of 20, 30, 40, $50 billion because that's the sort of wealth that Indian monopolies create, right? So the cooking oil market, for example, is run by two families. These two families added up, you're easily looking at $40, $50 billion of wealth, right? Similarly, the baby milk powder market in India, like in many other countries, is one company, Nestle. The cigarette monopoly is one company, small cars is one company. There's basically around 25 such monopolists in India. They pretty much make up the entirety of India's profits, right? 25 incredibly powerful monopolies. Now, the average return on capital that a dominant Indian monopolist makes is 45%. The average ROC of a dominant Indian monopolist is 45%. And one of the things we realized around 4 years ago is there is no large economy in the world which can hold a candle to India in this regard, right? So for example, if you take companies like Microsoft, Google, Facebook, Amazon, Toyota, Walmart, Tesco, BP, Shell, Daimler Chrysler, take whichever world-class company catches your fancy. You'll see outside India, if a world-class company has 20% return on capital, typically books will be written on such companies, right? In India, the monopolists that we cater to, they don't step out of their house for 20% ROC. Like 20% ROC in India is seen as a fairly pedestrian number. The Indian monopolist only gets out of bed for a 30% ROC. And people like us have started realizing that dominant franchises in large sectors end up with 45% ROC. This 45% return on capital employed is the core to the consistent compounding formula that we've been able to create, right? Why is that? Now let's go a little deeper, right? So superficial stuff done. Now we'll ramp up the difficulty. For any company anywhere in the world, right? For any company anywhere in the world, the free cash flows that a company generates, like the surplus that a company generates, is typically return on. The simplest way to calculate it is return on capital minus cost of capital, right? And the book that first launched our sort of business in India, this book, right? The book that really launched our business, what we were able to show in this book is that a typical Indian monopolist has a return on capital of 45, assume for simplicity cost of capital of 30%. Out of that 30% surplus, right, ROC minus cost of capital 30, the Indian monopolist will dividend out 1/3 of this. 1/3 of 30% he'll dividend out. That finances his lifestyle. Right? He doesn't have to steal money. He can live a London, Singapore, Dubai lifestyle by dividending out 1/3 of his massive surplus. The surplus is 30% of capital employed, which is quite staggering. Right? You'll find very few markets in the world where large companies deliver so much free cash flow. Out of the remaining amount, so 1/3 is dividended out, two-thirds of 30%. Two-thirds of 30% is 20%. 20% capital employed will be slammed back into the business, right? So 1/3 will be dividended out, two-thirds of 30%, two-thirds of the surplus will be slammed back. The typical Indian monopolist will grow free cash flows year after, the typical Indian monopolist will grow capital employed at 20% year after year, right? He's reinvesting back two-thirds of 30%, which means he's reinvesting back into the business, 20% extra capital. How is he reinvesting that? He's setting up new factories, he's launching new products. It doesn't matter whether COVID is raging or malaria is raging, whether Trump is president or Biden is president. These people really don't care. Every year they will grow capital employed by 20%, right? So if you go and see the balance sheets, if you look at the capital employed figures for Asian Paints, for Nestle, for Pidilite, for Divi's Lab, the sorts of companies we invest in, you'll see capital employed goes up every year by 20%, right? And now this 20% growth in capital employed is just divine for you and me, because provided the owner has a modicum of common sense, as he grows capital employed every year by 20%, your and my free cash flow to equity, the companies that we are investing, they're free cash flow to equity. What is free cash flow to equity? It's profits. From profits, you subtract working capital. From that, you subtract capital expenditure. And that's what's free cash flow. So discerning investors don't look at profit. Discerning investors look at free cash flow. Free cash flow, the world over, the measure of a company's success is not profit, it's free cash flow. And in India, what we find is dominant franchises, their free cash flows grow at 25%, right? Year after year. Whether you take the last 20 years, the last 10 years, the latest 5 years, the 5 years prior to this, the 5 years prior to this, 25% is typically the rate at which free cash flows compound for dominant monopolists in India. And the result of that is share prices, right? Our wealth, the owner's wealth, right, grows at 25%, right? The last 20 years, the last 10 years, the 10 years prior to, so the latest 5 years, the 5 years prior to that, the 5 years prior to that. It's actually a very metronomic process, right? Capital employed growing at 20%. Free cash flow and share prices moving at 25%, which means 10x in 10 years, 100x in 20 years, 1000x in 30 years. This is in rupee terms, folks. For dollar depreciation, you can knock off 3-4% to account for dollar to the US dollar depreciation to the US dollar 3-4%, right? And that's really the story of India. Step one, you and I are looking for clean companies. If the company steals money, then you and I can't make money. It doesn't matter how wonderful the product is. If the owner steals money, you and I won't make money. That's the first thing. Second is, not only does the company have to be clean, the owner, the management has to have some brains, right? If they're incompetent business people, you and I can't make money. How do we gauge competence? Look at return on capital relative to cost of capital. ROC has to be higher than cost of capital over a decadal cycle. Otherwise, there's no point investing. Step three, amongst these companies who are clean, who are competent, amongst these 40 odd companies, our job is to invest in 12.5 of these companies who are not just clean, who are not just competent, who are also monopolists. Now, what is a monopolist, right? What is the easiest way to understand a monopolist? And this is where I think business schools send you down the garden path, right? Where the conventional business school education asks you to look for monopolies. They ask you to look for pricing power in terms of, can the company hike prices and so on. The more effective way for looking for monopolies is to say, if a new player enters the sector and offers the same product, say 30% cheaper, will the company that you and I have invested in, will that company have to cut prices? If the answer is no, it won't. Even if someone new enters the sector, let's take an example. Even if someone new enters baby milk powder in India, the infant milk powder market, and they cut prices by 30%, Nestle will not even think about cutting prices, right? There's no point them cutting prices. Nestle is a compounding machine. You can look at the compounding there. Nestle's compounding has got nothing to do with the price at which they sell baby milk in India. And therefore, if a new player enters the market, they're not going to cut prices. Similarly, Titan is our largest jeweler. Titan owns a company called Tanishq. They are India's largest jeweler. Titan's making charges are a 20 to 40% premium on the competition, right? They've compounded by 30 to 40% over the last 20 years, which means they've created around 250 times. They've created shareholder value of 250x. the competition is already 20 to 40% cheaper. Titan doesn't care. They're not going to cut their prices because price is not something on which their dominance is based, right? Now I can do this sort of thing for all our investing companies, but it's not going to, it's going to get a little repetitive. So one way for you and I to understand why is it that a handful of companies in any country, right, whichever market you're investing in, you'll only find a handful of such companies where even if the competitor were to slash prices 20 to 40%, the company you are investing in won't be affected, right? Now, how do we identify such companies, right? So the easy part is clean accounts. Easy part is ROC above cost of capital. Where you have to work a little harder, where we have to work very hard, I have to be honest, is in understanding why is it that some companies are able to do this and others can't, right? So I've deliberately chosen a company which many people in India, until we convinced people otherwise, many people in India thought was a run-of-the-mill company, but we've been able to show that it's not, right? So this company is called Relaxo Footwear. This is India's largest footwear manufacturer. It was created around 25 years ago. And what they've done over the last 10, 11 years is almost a prototype of how to enter a highly competitive market and turn it into a dominant monopoly, right? So I'll give you sort of a little bit of background on Relaxo, and I'll explain how they built a powerhouse compounding machine, and how over the next 10 years, even if you never see me again, why you can make a lot of money by investing in this straightforward franchise, which is utterly dominant with no competition anywhere remotely in sight. So till the late 90s, these people were low-profile footwear manufacturers in the suburbs of Delhi, in an industrial suburb of Delhi called Bahadurgarh. Their footwear wasn't particularly distinguished. My parents left India in the early 90s. Until then, I remember Relaxo Footwear was not something you really thought about that much. In 2007, they hired Accenture. In 2007, these guys hired Accenture for what turned out to be a 10-year project to reduce their receivable days, their debtor days, right? The number of days it takes them to collect revenue. So Accenture installed SAP, and year upon year, using the SAP installation, they crushed their debtor days, the receivable days, right? So by 2017, they were down to 30 days. It takes them 30 days. It takes Relaxo 30 days to collect revenues. It takes Bata, the multinational company, 90 days to do the same thing, right? So compared to anybody else in India, Relaxo collects revenues in 1/3 the time, courtesy superior SAP implementation. Now, any company that collects money quicker will have more cash flows, right? By definition, if you collect money quicker, you'll have more cash flows. And the counterintuitive thing that Relaxo did from 2010 onwards was to use that superior cash flow to set up new plants, right? Why is that counterintuitive? Because the world over, everybody, Nike included, outsources footwear manufacturing. The conventional point of view is the footwear manufacturer should focus on design and branding. Production should be outsourced. These guys said, no, screw that. We will actually set up factories. And over the last 12 years, they've set up 8 factories in the outskirts of Delhi. They're now by a factor of 6, the largest manufacturer of footwear in the country. They make 200 million units of footwear a year, compared to the closest rival who makes 40 million units of footwear a year. Because the scale of footwear manufacturing is so colossal now, they get the raw materials for making this stuff at half the cost of what their competition gets, right? And as a result, even though they sell, say, their entry-level products are $1.50, US dollar $1.50, around 100 rupees, even at $1.50, their gross margin is 60%. Their operating margin is 17%. Companies who are selling footwear at 5x, 6x the price aren't able to match those profit margins, right? So first thing, crush working capital cycle, deliver surplus cash. Second thing, use surplus cash to build colossal scale. Use that to crush the cost of manufacturing, crush the unit economics, so that even if you're selling something at a $1.50 price point, which is entry-level footwear in India, you're still incredibly profitable. Then 2017, they hired BCG and Deloitte for another round of upgrading, right? And what BCG and Deloitte told them is that, look, you've done ever so well in entry-level footwear, in what we call chappals or Hawaiian floaters, I think you'll call them in outside India. You've done ever so well. Why don't you replicate this in sandals? So they launched, so there's something called Crocs, which is a foreign product. It's incredibly expensive in India. These guys launched an entry-level Crocs, They didn't call it Crocs, they called it Sparks. They launched it at 1/5 the price point, and they've dominated the entry-level sandals market as well. And then they launched entry-level sports shoes at, say, around the $15 price point, and they become dominant there as well, right? So 2017, they broadened their offerings beyond entry-level footwear into beyond entry-level floaters to entry-level sandals and shoes. And then they began another part of upgrade, which has transformed the business another notch. Till 2017, what these guys were doing, what Relaxo was doing, was they were using wholesalers, right? Now, in any country, there are retailing involves wholesalers, distributors, and dealers. Wholesalers basically control a whole territory. Relaxo, for example, would go to the wholesaler for the state of Rajasthan and say, look, here is the Rajasthan consignment. I'm going to give you the consignment, you're going to give me the payment, and then what you do with the consignment, Mr. Wholesaler, is your headache. And what BCG told these guys in 2017 is, look, guys, you can't build competitive advantage like this. So over the last 5 years, what Relaxo has done is not only appointed wholesalers, they've also appointed for each city. In each city in Rajasthan, they would appoint a distributor. And then they incented the distributor to build out the retailer. Retailer is the last mile, the fellow on the high street who flocks their product. Back in 2017, they had nearly 10,000 retailers selling their product. Today, they have 50,000. Through COVID, they doubled their retailer count. If you add up all the other footwear manufacturers in India today, put together the rest of the footwear manufacturers won't have 50,000 retailers. Relaxo alone has 50,000 retailers. So if you now step back and look at Relaxo, they have the tightest working capital cycle, the lowest cost structure, by far the most extensive range of entry-level footwear, and they have the most extensive distribution. Right, and you've got India's monopoly compounding business ready. This company has already compounded free cash flows in the last. If you go back to these slides, you'll see Relaxo's free cash flow compounding. Sorry, it's not here. It's another slide. Relaxo's free cash flow compounding the last 5 years has been around 35%. Now they've built out the entire system. Right, they have built out the entire system in terms of product and channel. They are ready for what we call the formalization of the footwear market. Now, what is the formalization of the footwear market? The Indian public buys 3 billion units of footwear a year. Out of those 3 billion units, 2.5 billion is made in the black economy. Only 500 million is made in the formal economy. Out of those 500 million, Relaxo manufacturers are 0.2 billion. So our formal sector makes only 500 million. Relaxo makes 40% of that. But the big story is the informal, the tax evading sector. Each year in India, the tax evading sector is dying a little bit as the government cracks down on tax evasion. As that tax evading sector dies, and the tax evading sector, remember, is colossal. 2.5 billion units of footwear are in the tax evading sector. As that dies a little bit, every year customers are thrown into Relaxo's arms because the tax evading sector customer pays a $1 to $1.50. The only organized sector manufacturer who makes footwear at $1.50 is this guy. And as therefore the Indian footwear sector formalizes, Relaxo at $3.5 billion market cap is beautifully placed to compound over the next 10 years at 10x for us. Right? So this is how giant monopolies are built. Some of the monopolies we invest in are around $3 billion like Relaxo. Some of them are more like $30 billion like a Nestle or an Asian Paints. But the common feature across all of them is the ability to compound free cash flows, and therefore our clients as well at 10x in 10 years. So I'm going to stop there. Otherwise, people will sort of get bored out of their skulls. I'm going to stop there and hand it back to Rupam.
Thank you very much, Saurabh. That was actually very eye-opening. I hope you guys got a good sense of what deep research means and how to really extract those few gems from large number of companies. And the stats that you shared, this is actually quite staggering. Like 20 of the companies in a country as big as India, I mean, generating 80% of the profits. Now I'm pretty sure that if we look at the other markets in the world, I mean, while the number might not be as extreme, but they're also a small handful of businesses. They capture most of the profit. So that gives us a fantastic insight. And in MoneyWiseSmart, we focus on quality. So we have a list of companies which we think are high quality, and I think this is something that we need to keep in mind, Fan Liang and Sudan, that every country that we are looking at, be it US, be it Brazil, Singapore, Japan, I mean, we have to identify those.
So point worth making is, if you look at, say, America today, in America, the top 20 companies take home around 35% of American profits, right? But if you look at America 100 years ago, was exactly where India is. 20, what they called in that era, they called it American robber barons, Rockefeller, Carnegie, Standard, and so on.
Yeah.
America around 1930 was exactly at the juncture where India is today, right? So this is a point worth remembering. If you guys invest in Western markets, it'll be very difficult for you to find countries which are as consolidated as India. By consolidated, I mean 20 companies taking home the lion's share of profits, right? Typically, in stages of development, once a country becomes a developed economy, right, profits become more fragmented. Yeah. It's when countries are in India's per capita income is $2,000, right? 1/10 of America, right? Once another 20 years hence, when we hit, say, the $10,000 mark, we too will become more fragmented. So it's this stage of development which is magically powerful, where you're able to lock into giant companies dominating the country. Because India is a large economy, we're already the world's 5th largest economy. Yep. Although we're the world's 5th largest economy, we're still a very poor country. Yep. And it's this combination of low per capita income, poverty basically, is this combination of poverty and scale which makes India such a compelling investment. In America, you have scale, but you don't have low income. So you can't generate high ROC. If you can't generate high ROC, your surplus is modest. In places like Bangladesh and Vietnam, you have similar per capita income to India. And therefore, you have in Bangladesh and Vietnam high ROC companies. But the problem there is these countries don't have a very long growth runway. In India, you're combining massive scale with massive poverty. And basically, it's like a dream situation for compounding and creating colossal wealth.
So Saurabh, I mean, we have our attendees. I can see a lot of them are from Singapore, but there are people from Canada, there are people from US, I can see people from UK. So let me throw the first question to you, and I'm sure that's a question which, people also have. How do they access the Indian markets? Because, one can't just go and start buying equities, right? Of foreigner. I mean, I can, because I have a Indian brokerage account. So can you,
so look, I wouldn't know the tactics. I have to confess, I've never really. So I invest in the UK through my erstwhile the stockbroking account, or rather the wealth management account I used to have when I was in the UK. I have to say I don't know the counter for people who are non-NRIs. If you're an NRI, if you're a non-resident Indian, then it's straightforward enough. You basically approach your Indian bank, whichever Indian bank you have an account with, and the bank will help you attack the Indian market through their brokerage operation. So whether it's HDFC Bank or an ICICI Bank, just go to, if you're a non-resident Indian, it's straightforward enough. If you're not an NRI, say you're a Canadian person or a British person, then I don't exactly know how to go about it. I've heard that Interactive Brokers, I think they're called. They offer these sorts of services in many parts of the world. But Rupam, I won't be able to tell you how your audience can open an Indian brokerage account. That's it's not.
But if they want to take the fund route, let's say in a fund like yours, like what is the modality for a non-Indian person? Do you have a vehicle through which a non-Indian person?
So we have a tie-up with Kotak Asset Management. Kotak Asset Management is a platform in Singapore, and through their Singapore platform, Kotak Asset Management has a platform in Mauritius, and through in Mauritius there's a fund structure that they have, and via the fund structure, those who are listening, they can invest in what we do, right? So the fund is based in Mauritius. It's the money is being commingled in Mauritius, so to speak. It's a Kotak platform. Kotak is one of India's largest banks, their asset management platform in Mauritius. And whoever's interested, we're happy to put you in touch with the Kotak team. There's a Kotak team sitting in Singapore. There's one in London. There's one in the United States, and so on and so forth.
And this will be USD.
The money comes into the fund as USD. Absolutely, the money comes into the fund as USD. But obviously, when we invest in the Indian market, it becomes INR again. It becomes rupees again. So basically, it's underlying investment is in rupees, but the fund is denominated in dollars.
Okay. Now, in terms of corporate governance, now of course, these 20 companies. I mean, I grew up in India, so I'm familiar with these companies. I must say that I'm not as familiar with Relaxo for the very same reason that you mentioned, because I moved out of India a couple of decades back, and I think Relaxo's main growth happened for that. So what kind of process does you and your team spend in evaluating the corporate governance issue? So two questions. One is the corporate governance, and capital allocation you already touched upon.
Sure. So I think the first step, as I described, the first step, relatively straightforward step, is to look at accounting and look at theft, right? And the forensic process I took you guys through, the forensic process is intended to uncover theft, and that's the sort of minimal layer of, that's the first and the most basic layer of hygiene that one has to apply, which is this guy stealing money from minority shareholders, from the banking system? Then once he's made it through the basic filters, before we invest in a company, we put them through what's called the longevity framework, right? I've sort of displayed it here. The longevity framework, Rupam, broadly splits into two parts, right? The left-hand side, this is sort of conventional business school analysis, right? Which is to say that, is this company's return on capital higher than cost of capital, which means they have free cash flow. If they have free cash flow, what is their reinvestment rate, which means how much of the free cash flow is being pumped back into the business, because that's the sense of how quickly the business will grow, right? And if they have return on capital or cost of capital, what is their moat, right? On what basis are they being able to generate an ROC above cost of capital? So in Relaxo's case, it's superior business processes, it's the widest distribution network, it's the tightest working capital cycle, and so on, right? So that's this sort of stuff. The left-hand side stuff is actually quite straightforward, right? It's the right-hand side stuff where actually we end up spending a lot of time and effort, and this is both governance and also the sustainability of the franchise, right? How long will the franchise continue compounding cash flows at a good rate? The longer, the better for us, right? So how can we calibrate? How can we calculate? How can we estimate how long the franchise will continue growing cash flows at a good rate? So the first thing we tend to look for is when we see the last 10 years of annual reports, how much energy / how much lethargy is the company showing, right? So how do we measure lethargy? We look at things like, over the last decade, can we find tangible proof that this company has got stronger year upon year upon year? So for example, has the working capital shrunk? Has the working capital cycle shrunk steadily over the last 10 years, right? Have we seen the company bring to market new products and services at a consistent rate, right? Have we seen attempts by this company over the last 5 years at radically disrupting the status quo, right? That's the lethargy score. And then the final element, which is both governance and sustenance, is succession planning, right? Fundamentally, the simple question we ask in succession planning is this a one-man or one-woman show? Is this a one superstar show? Or is this actually an institution which consistently hires good people, trains them, turns them into capable managers, then into great leaders, puts them in board positions, and compounds your and my wealth decade upon decade upon decade at 25%. So for example, if you see TCS or if you see Asian Paints, TCS is now the world's second largest IT services company. In 40 years, they've had 3 CEOs. In the history of TCS, there hasn't been a single boardroom director who wasn't hired straight out of college. TCS is spectacular at this, right? Generating for generation after generation, hiring bright people in their 20s, grooming them, and in their mid-40s, early 50s, making them boardroom leaders. They've never had to laterally hire senior roles, and they've grown free cash flow at 25% for the last 20, 25 years, right? Similarly, say Asian Paints. For 70 years, this franchise has grown at 25%. For 50 years, they've hired from India's best and brightest from India's top business schools at early age. And then they've trained them, very low churn, almost zero churn in the boardroom, and consistent ability to groom people for senior roles over the course of 10, 15 years. So that's succession planning. And if you see companies who fit this criteria, they're hiring bright people, consistently grooming them into world-class leaders, creating a lot of wealth in that process. They're showing lethargy, they're showing energy, they're showing enterprise. That's coming through in the financial metrics, that's coming through in new products and services, that's coming through in radical disruption. That's when you really build comfort that not only are the accounts clean, this is actually a really well-governed, world-class compounding machine.
That's amazing. In fact, guys, I have to say that when I read this book, I don't think you can see it because of my background, the coffee can investing book. I mean, we in MoneyWiseSmart, we are worshippers of compounding. We just follow one religion, that's compounding. And I don't think there is any other book which has explained the whole concept of compounding in such a great way. Saurabh has talked about longevity, and today some of the quiz questions that we have are actually related. Okay, so
just in case people want to buy this, because since you guys live all over the world, We're not going to be able to, I'm not going to be able to get it to you from India, but whichever country you're in, Amazon sort of sells the book in, you can see that the Audible format, courtesy Mr. Bezos. Audible format is available free of charge. I think it's available free of charge probably globally. And the Kindle edition is $1.50, and that's the hardcover edition. So this book, the one that Rupam is very kindly saying good things about, this book is the simplest of our books if you want to understand how consistent compounding can make you very wealthy. If you are interested in digging deeper into moats, right, and you are interested in understanding the tactics and the strategy of building monopolies, then this is the better book for you. If you really want to get into the guts of how smart management teams kill the competition and build powerhouse monopolies, then Unusual Billionaires is your book. And if you want to do more, fundamental sort of analysis on forensics, on companies' barriers to entry, right? This book, Diamonds in the Dust, the book last year, is the better book to go for. So courtesy Amazon, you can get these anywhere in the world. And I guess they've got this, or at least in India, they give it away free on Audible. So if you're driving or in the gym or something, you can listen to that. And the Kindle editions are pretty inexpensive as well.
And don't worry, I mean, actually, we will be giving away some of these books today, I mean, to the quiz winners. I can comment about the Unusual Billionaires. There, Saurabh takes up the case studies of, some of these businesses that he talked about. He has talked about the Asian Paints, he has talked about Berger Paints, he has talked about HDFC Bank, he has talked about Axis Bank. Now, and this is something which I would like to tell to our community members, our subscribers. It's irrespective of which country you're in. For example, if you are evaluating a bank, the way they have talked about HDFC Bank and Axis Bank, their cost of raising deposits, the exact same models you can go and apply to, banks in any other countries. And funnily, when I was reading this book, and in my mind, I was thinking of Bank OZK, and I was trying to compare the same metrics, and it's very relevant. Then another company is Marico, and it's interesting how little people from outside India know about the kind of returns these companies have generated for their shareholders. Marico is a company that Saurabh and his team spent a lot of time researching, and I have a connection because the CEO Shogoda, he's actually my senior from the same hostel. So I kind of feel very proud about the fact that our hostel, our dorm in IIT is the place where Sundar Pichai comes from. This guy Saurabh Gupta comes from. So many of them, and I know them personally. Okay, so let's take while you guys let your questions come in. Let's start with a quiz break. Okay, so today the theme of the quiz is basically compounding longevity, and Saurabh has talked about longevity. So the first question is, which is/was the longest continuously operating business in the world? Now, the rule of the quiz is, let your answers come in through chat, fastest finger first. Google it if you have to. Obviously, people who know the answer will have an advantage, and whoever gives the correct answer gets 10 points. My partner Fan Liang, he will be noting it down, and we will be adding the points. So which is the longest continuously operating business in the world? Does anyone know? Okay, we already got a correct answer. I think Andre Robinson, Andre got the correct answer. Congo Gumi. KM, you mentioned it correctly. It's a business that fixed temples in Japan, but unfortunately, you didn't give the name. So it's a very interesting. Let me just tell you a bit about this company. This company was established in 578 AD. Is the oldest continuously operating company in the world. Now, as you have noticed, I'm using is and was interchangeably. I'll soon tell you why. Now, its headquarters are located in Osaka, Japan. This construction company was actually founded by a Korean immigrant who was commissioned by Prince Shotoku to build, I hope I'm pronouncing it right, Shitennoji Buddhist temples. Congo Gumi was a family-run company for 1,428 years until 2006, when the company struggled financially and became a subsidiary of Takamatsu. Now, before the merger, it had employed just over 100 individuals and had an annual budget of around 70 million. So it's not a big company. But the interesting thing about Congo Gumi is, and that's the irony, the business survived for over 1400 years, a long list of earthquakes, tsunamis, for which Japan is well known. It survived the Meiji Restoration, world wars, atom bombs. But the one thing it could not survive is the burden of debt. And finally, it went, it was on the verge of bankruptcy, and that's when it got taken over. So it's actually an amazing story. Okay, so Fan Liang, you noted, right? 10 points for Andre Robinson.
Yeah, so 10 points for Andre. Congrats.
Okay, all right. So the next question. The next question actually, Saurabh has kindly sent us. So, in fact, I have taken the liberty of slightly changing the question because, we have people who are, fairly experienced in investing. So what is the definition of working capital? What is the formula of working capital? Working capital. I don't think I need to give you options. I'm sure someone will get it. Okay. KM says capital required for the company to operate. Perlin says CA minus CL. So yeah, I asked for the formula, and I think we should give it to Perlin because CA stands for current assets, CEL stands for current liabilities. But I think we should give 5 points to KEM because he got the sense right. Saurabh, what do you think? He pointed out that capital required for the company to operate. Should we? Your decision is final.
So this is really tough. I think on the chat that I'm seeing, Rupam,
Yes.
Perlin got the formula right.
Yes.
Right. So CA minus CL. Now he or she did use abbreviations, yes, but that's fine. I think CA minus CL. So it's a tough call. It's a really tough call because at one level, I think KM also did a good job by saying capital required for the company to operate. But since that's a slightly fuzzy definition, whereas CA minus CL is more precise, I would go with Perlin.
Okay, so Perlin gets the 10 points, and KM, because I know he's our.
This is quite stressful. This is quite stressful. You've got a very competitive client base here.
Yeah, I know, and I know he would know the correct. So while in a way in a balance sheet you have the working capital, you also have the PP&E, which is also required. That's for the company to operate. But here I'm making a judgment call. I know that KM knows it, so let's give him 5 points. Fan Liang. Okay, all right. But yeah, a lot of others also got the correct answers, but fastest finger first. So, let's move on to the next one. Okay. A gentleman named Peter Minuit was the third director of the Dutch North American colony of New Netherlands from 1666 until 1631. He has been credited to purchasing a piece of real estate, which is now well known, in 1626 from the Native Americans for $24 worth of trinkets. What is the modern name of this piece of real estate? What is the modern? Okay, all right. Andre, he got it. That's right.
And Rupam, I think because you were reading out the question, Andre actually put in the answer before you finished the question.
Hey guys, okay, Andre, I know you know this, but this is a warning. You have to wait for the question to get over, okay? Otherwise, because I mean, I know some of the I know how Andre knows it, because this was actually a case that we in our course, investing fundamentals course, we talk about compounding, and you would have seen that. But okay, this time, Andre, we give it to you. Kent, yeah, he bought it for $24. And this shows the power of compounding. Just imagine the entire Manhattan Island. Today it was purchased for just $24.
And somebody must have told the guy this is looking overvalued at 24.
Yeah, I'm pretty sure. And I had some time back done the calculation. I think the compounding rate worked out to some just 3.5%. I mean,
very interesting.
Yeah, it's pretty amazing. Okay, all right. So I think Fan Liang, Andre is top of the leaderboard. You got 2 right?
With 20 points now. Pauline 10 and KM 5.
Okay, guys.
How many books are we giving up?
We will, depending upon how many win. We are being generous, So I'll announce that, but 2 definitely. Okay. All right. So question number 4, formula question. So Saurabh has talked a lot about return on capital employed. What is the formula for return on capital employed? So I would like the formula now here. Just a note, there can be couple of different acceptable versions of that formula. So so if you come up with any of the correct one, we will operating earnings by capital employed. I think we will. I'm inclined to give it to Kent Lee because he spelled out the formula. But sort of what do you say? Eric Neo says operating earnings by capital employed. So your decision is final. Should we give him some points?
So I think Kent's formula is more precise. I think I'm just told on because other people are firing there. And there's Kent Lee, EBIT. The only area where I'll differ with Kent, and this is where it does get a little subjective, is we tend to use in Marcellus EBITDA, EBITA.
Yeah.
We use working capital plus fixed assets. Plus cash in bank, which by the way ends up being broadly similar to the denominator. The denominator is the same thing. The numerator we differ a little bit, but I think of all the people who responded, Kent's one is closest to the way he's defined it is closest to what we do. And interestingly, everybody's gone with EBIT. So you can use EBIT. We tend to prefer EBITDA because the amortization bit we also knock off. But I'll go with Kent.
Okay. All right, that's great. And I probably know why many of them have gone with EBIT because that is what kind of we talk about. And the denominator, I'm sure you all. I know that you understand that this kind of works out to the same. So there are 2 ways of looking at the capital that's going into the business. The total assets minus total current liabilities, or you can take the working capital and the fixed assets, which is the PP&E. So that also can be used. But the broad idea is is understanding the concept that a business takes capital to run, and on that capital the business throws out an operating return, and part of that return the business returns to the shareholder either via dividends or share buybacks, and the higher the business is able to reinvest and generate generate a high return on that reinvestment. I mean that.
If you ask me, 50% of investing is just understanding this ROC formula properly.
Oh, absolutely.
Because free cash flow then becomes very easy to calculate. Free cash flow is nothing other than ROC minus broadly the cost of capital.
Absolutely.
It becomes very simple then.
And I think another thing which lot of people kind of miss out is a business might generate very high return on invested capital, but unless they're able to allocate that capital, if that cash is just sitting on the balance sheet, then the long-term returns will suffer. In fact, a classic example is Apple. For a very long period of time, Apple was sitting on $100 billion of cash, and the returns on that cash was actually not high. In fact, Fan Liang and I, we have evaluated businesses in China, a company called 51 Job, great operating results, but they were clueless about what to do with the cash, and that was pulling down their overall shareholder return. So when you look at the ROC, that takes into consideration that. Okay. So that's great. So Kentley gets this, right? Okay, 10 points. Next question. All right. Okay, so this is a long one. And please hold on till the end of the question to be fair to everybody. She was one of 8 children of Solomon and Chasya Gorilik and was born in a small village in modern-day Belarus. Her father was a rabbi and her mother ran a grocery store. She immigrated to the United States in 1917 and could not speak a word of English. In 1937, she borrowed $500 from her brother and set up a store selling furniture cheaply. She underpriced all her competitors and was even taken to court by her competitors. The judge who heard the case not only ruled in her favor, but ended up buying some carpets from her after the court session. She eventually sold 80% of her business, which happens to be the largest of its kind in North America, to a well-known investor in 1983 for $60 million. She continued to be involved in day-to-day operations, which is basically 7 days a week, until shortly before her death at the age of 104. Who am I talking about? Who am I talking about? Okay, already I can see people have got it right. So Fanlian, who gets it this time? Sebastian says Mrs. B. I think we can give it to him. Okay, yeah, he later spelled out. Calvin, you mentioned Berkshire, who was the purchaser, but yeah, Mrs. B. Rose Blumkin was the correct answer. And the funny story is that at the age of 94, she was literally forced into retirement by her children and grandchildren, and she was so full of energy. She was not happy about retirement. So she goes across the street and sets up a competing business. And that was one thing Buffett repents, that he says that, it was a handshake deal. I never bothered to hire an audit company to audit her books. But there's one thing I repented, was not to enter into a non-competing agreement with her, because even at the age of 94, she started making profits, and finally Berkshire went and bought her also out, and then merged the company, and finally she was given back her throne. So she continued to operate till the age of 103. It's absolutely amazing, this story. Okay, great. Next question. Who said, "In my whole life I have known no wise people over a broad subject matter area who didn't read all the time"? None, zero. And here also, this question is from Saurabh, but I have taken a call and not giving out the options, because I know some of them will get it right. And yes, okay, again, Sebastian. So Sebastian is giving good competition to Andre.
Rupam, I think at least on my end, I see Sharon first. Sharon got it out just when you finish the question.
Yeah, you're right. Sharon got it right. Okay, Sharon. Okay, Sebastian. Sorry, you have to be faster. That's right, Charlie Munger. All right. So things are heating up. Okay, the next is again a compounding question. Now, your great-great-great-grandfather had left an estate 100 years back with two separate $500 portfolios comprising different sets of 5 stocks each. So each of the portfolios contained 5 different stocks. With $100 invested in each stock, you and your sibling inherited the 2 portfolios. So the trustees of the estate informed you that you inherited portfolio A, which contained 5 stocks, and each of them survived the 100 years and compounded at 9% each. So all 5 stocks survived and they delivered a CAGR of 9%. Your sibling inherited portfolio B, which also contained the initial 5 stocks, but over the 100-year period, and this is the true sense of coffee can portfolio, over the 100-year period, 4 of those businesses went bust. So they went to 0, and only one of them survived, and this business generated a compounded return of 11%. So whose inheritance is larger, yours or your siblings? A little bit of math. Okay. Sharon says B, Apurv says B, Mengvi says A. Okay, so B is the correct answer.
And Rupam, sorry, yeah. just on the part where people should only answer once you finish the question, I was looking at the chat just now. I think Mengwi was the first one who really started answering after you finish the question. So it's your call whether the answers before that stand or not. Yeah. Yeah, but Mengwi answered A, which is anyway not the correct answer. The correct answer is B. So the portfolio A, where all the 5 companies survived, but they compounded at a rate of 9%, in 100 years, the $500 compounds to 2,764,520. Whereas portfolio B, where just one company survived, but it compounded at just 2% more, 11%, in 100 years,
just that one company compounded to 3.4 million. So that tells you the power of compounding. And there is a very interesting learning here, which also is further explained and highlighted in Saurabh's books. That when you are a long-term investor, and let's say you have a portfolio of 10 stocks, now things happen that's beyond our control, and some of the business may not keep the promise. But the beauty of compounding is that the underperformers become lesser and lesser percentage of the portfolio, and the ones which are compounding, they become a bigger and bigger share. So that often we try to speculate, we try to go and do rebalancing and stuff like that. But this itself is a form of rebalancing, where the underperformers, they become a lesser percentage, and the weight is carried on the shoulders of the overperformers. So I have exaggerated the time frame as 100 years, but this is a very important principle to keep in mind. So
if you don't mind,
yeah, sure.
One of the most counterintuitive theorems in maths, but it's one of the theorems in maths which is most useful for investing, right? It's a very simple theorem, and you can use this in many different ways. So the theorem is this: if say a mathematical function, say A is a function of x and y, say A is a function of x and y, and say x is going up, y is coming down, right? What will happen to A, right? So when I first came upon this problem, when x is going up and y is going down, I used to think, well, it depends, right? Whether x and y, x or y is dominant. But then what this maths theorem says is it doesn't depend. If x is going up and y is going down, A and x will move together if you stretch time out.
Absolutely.
So A is a function of x and y can go down as much as you want, and x will go up a little, but A and x will move together, right? This simple maths theorem has many different uses in investing. One of those uses you just nicely pointed out. It's a mind-blowingly counterintuitive theorem.
Absolutely.
And it's very, very useful in investing.
Absolutely. In fact, just few days back, myself, Fan Liang, and Sudan, our other colleague here, we had a internal discussion on share buybacks, and they're also we highlighted this fact that when a company is let's say buying back 10% of the shares, the resultant shareholders, their share is not going up by 10%, but it's actually going up by 11%. And over time, this is huge. And you rightly said that this is very counterintuitive, because people don't think, there's some of the magics that happen in a portfolio over a long period of time, because
so let's take another example, right? So the share price of any company is a function of the PE multiple and the earnings, right? Now, the PE multiple can halve over the next 10 years, which means it goes down 7% every year. And say the earnings go up 20% a year. You'll end up compounding with that company at close to 15%. Yep. So the PE multiple is halved over 10 years, down 7-8% a year. The earnings are going up, say, 20% a year. Over 10 years, you'll compound it close to 15%, which is over 10 years, your wealth will grow 5x, even though the PE multiple is halved.
Yeah.
But you tell anybody, if Rupam tells somebody, look, I'm going to invest in a company and the PE multiple is going to halve over the next 10 years, people will say, oh my God, what a disaster.
Yeah, exactly. That is the beauty of compounding. Now, unfortunately, it's a very sad thing that if you look at the stats globally, the average holding period of stocks has dramatically shrunk. I mean, now literally it's because everybody is just focused on the stock price, whereas the real magic is happening inside the company. And here we always believe that there is something of an availability bias, because the stock price is easily available at your fingertips, so people are just looking at it. Whereas the operating business is where the real wealth is getting created. So all right, so let's move to the next.
So for this question, I think Sharon, who got it right, she answered before you finish your question, and the first person who answered after your question is CW. So
okay, so let's give it to Sharon.
Yeah, and I think maybe for future, if for it to be easier to make sure the cutoff of your question being finished, maybe you can just say you have finished the question, and then we'll count whoever who say after that. Yeah.
Okay, all right. Yeah. Sounds good. Okay, next question. Prior to emigrating to America, he was one of the student leaders of the 1989 Tiananmen Square student protests. He enrolled in Columbia University and was one of the first in Columbia's history to receive 3 degrees simultaneously, a BA in economics, an MBA, and a JD law degree in 1996. In 1990, he had published a book about his experience in China titled Moving the Mountain, My Life in China. He founded a fund which is known for its disciplined and value-oriented approach to investing and has none other than Charlie Munger as one of his investors. Who am I talking about? Who am I? Okay, all right, everybody knows this. So, Saurabh, you see, we have quite a smart bunch, you know.
This is, your client base is insane. This is unbelievable.
Yeah, I have to really, you know, I think that, you know, I
think I need to go up and
study got you. And then, yeah, not one, not two, you know, boom, boom, Lilu, everybody knows it. Okay, who got it right this time? Panliang. I can see Andre. Anyone before Andre? Okay.
No, I think Andre got it. Yeah.
Okay, Andre is taking it away. So leading, right?
Yeah, he's leading with 30 points, followed by Sharon at 20, and we have 3 ties at 10.
Wow, awesome, guys. Come on. Still few to go. All right. Okay, the next one. Her husband was the chairman of the company, but after his suicide, she assumed the reins of the business. In her memoir, she had even outlined her lack of confidence and distrust in her own knowledge. However, she went on to become the first female CEO of a Fortune 500 company, which was eventually acquired by Buffett's Berkshire. Buffett played a big role in coaching her while on the board and became a very close friend. She was listed as one of the outstanding capital allocators in William Thorndike's book, The Outsiders. Now, here is a hint. Her character was portrayed in a 2017 movie by Meryl Streep, for which she was nominated for the Best Actress Academy Award. Who am I talking about? Okay. Boom. Who got it right? My God, you guys are really fast. Okay. I think I can see K. Yam. The answer is right. K. Graham, Catherine Graham, and okay, K, you share the first name with her. So, you know, it's only, only fitting that you got it right. So Catherine Graham was the publisher of Washington Post, and you guys have to watch this movie, The Post. Tom Hanks and Meryl Streep. Meryl Streep was absolutely amazing. The way she portrayed the character, and it's amazing how she started. She did not have any background in business. Very tentative, very nervous, and was constantly being looked down by her male colleagues. From there to the first female CEO of a Fortune 500 company. So that's an amazing capital allocator. All right. So you guys are liking the questions? Do you want me to go on? Type yes so that I know that you're liking the questions. Okay, awesome. All right. Okay, there's enough interest. Okay. So this one, again, wait till I finish. Some of you who attended one of the earlier sessions might know this. In 1951, on a cold January Saturday morning, a young Columbia University student had a chance meeting with someone for the first time. The meeting went down, and please don't answer till I finish the question. The meeting went down as a very significant event in the annals of investing history. The young student wanted to learn everything he possibly could about a company called Government Employees Insurance. He never heard anything about that company even a week before that meeting. The person who he was meeting was the vice president of finance of that company and subsequently became the CEO of that company. The meeting lasted for 4 hours, and the VP kept answering questions from the student about an insurance business. The student had gone ahead and purchased the stock of that company the following Monday, and following Monday after the meeting, investing 65% of his net worth. 56 years later, that same student, of course, he was not a student any longer, bought the entire remaining shares of the same company from the same person he had met in 1951, who was now aged 97 years. This became one of the most historic long-term investing track records in a single business. Name the persons, the young student, the VP, and or the company. And here to get 10 points, I need all the 3. The name of the young student, the VP Finance, and the company that we are talking about. Okay, I want all the 3 to get 10 points because I know that you guys will get too easily.
And all three in one sentence, please.
All three in one sentence. Yeah. If you want to, get the one. I mean, the 21. I think by now it's no secret that someone is a fanboy of Warren Buffett. Almost all my questions are somehow linked to him. So Warren Buffett and Geico is fine, but I want all three. No, I still don't have the name of the VP Finance. At least, guys, Google. You have enough time to, I can't stop you from Googling, Okay, all right. Ellie.
Yeah.
Ellie got it right. Lorimer Davidson. So, as fondly known as Davy. So, Buffett credits him as the person who taught him about the insurance business. And that was, the most aha moment for Buffett when he realized that this is a business which takes in premium today, and the claims, sometimes it can be decades for the claims to come out. So it's, an interesting fact is most insurance businesses actually lose money in the underwriting section of the business, but it's investing the premium, which is called float, which, Buffett happens to be sitting on 147 billion of it right now. So it's a simple case of time value of money. And people who heard me speaking, I think the number of times I use the term time value of money, you would have got bored by now. So it was a complete aha moment for Buffett, and that was a huge. It was basically free money available to him for investing.
So, this is incredibly interesting. I'll need to leave in 5 minutes if that's all right.
That's okay, Saurabh. Thank you so much. So, okay, let me have you for one more question, and then we'll let you go. All right. So the next question is: name all the companies that have ever crossed a market cap of $1 trillion. Actually, sorry, I'm changing the question. So here is a list of all the companies that have ever crossed a market cap of $1 trillion. You have Apple, you have Microsoft, you have Amazon, you have Alphabet, you have Tesla, and Meta was part of this club for some time. Now, of course, it has gone down. Which are the others that have ever crossed a $1 trillion market cap? There are actually two. So I want both the names. Saudi Aramco is correct. That's one. And there is one more company that has briefly, no, not Berkshire, not Nvidia. Tesla, I have said. Tesla is there in my list. So yeah, Tesla is there. Okay, so the answer is, and this is something which a lot of people don't know. It's actually PetroChina. So on 5th November 2007, the A shares of PetroChina ended their first day of trading after the IPO on the Shanghai Stock Exchange and yielded a market cap of approximately 1 trillion. But the thing is, only 4 billion of the Class A shares were floated during the IPO, and another 158 billion of the shares were still held by CNPC, which is China National Petroleum Corporation. And that's the reason why you don't hear about PetroChina. But I think we can give 5 points to, who said Saudi Aramco first? Perlin. Yeah, Perlin. So Fanliang, I think we can give 5 points to Perlin. So Saurabh, thank you so much for agreeing to do this. I know you're a busy man. I hope you enjoyed interacting with this group.
It was a lot of fun. I learned a lot. Thank you very much, Rupam, for hosting me.
And thank you. And guys, stay back. We have a couple of more questions. And thanks, Saurabh.
My pleasure.
Thanks. Bye. Okay. All right. So Fanliang, can you tell us the leaderboard? How does it look like?
Yeah. So Andre is leading with 30 points,
yes,
followed by Sharon, less at 20. And
okay,
then we have Pauline and KM both at 15 now.
Okay. All right. That's good. Okay. So the next question is, which company bought back the most amount of shares ever. Over the past decade, their total buybacks were so large that their total buybacks almost was equal to the total GDP of Israel. Which company am I talking about? Apple. That was an easy one. Who got this? Ben Teo. Okay, Ben gets it. Apple. That was an easy one. All right. And the next is, who can tell me about the first recorded option contract? Who was the person who bought that option, and what was the underlying instrument on which that option contract was bought? So the first record of an option contract. No, Buffett S&P is not the correct answer. It happened way before that. So the first record of an option contract. Google says Samurai. No, that's not American financier. Okay. French guy buying gold from US. No, that's not. Okay, I think I will give it to Sebastian. Ancient Greece to speculate on olive. It's actually olive presses, but do you know who the person is who bought this contract? Okay, doesn't know. I think I'll give it to him. So it's basically yeah.
Yeah, on my end, I see Apu saying the same answer first. I'm not sure what you see.
Oh, one sec. I missed Apu. Yep. Okay. Apu got it. Apu got it first. Sorry, Sebastian. Apu got it first. Okay. You're right. So it was in Greece to speculate on the olive harvest, and the person was the ancient philosopher Thales, who in 6th century BC basically went and paid a deposit on, I think the name of the place was Miletus in Greece, if I remember correctly. He went and paid a deposit on all the olive presses because he expected a bumper crop. And that is exactly what happened. So the olive crop was a bumper crop. So there was a huge demand for olive presses, and he made an absolute killing in that. So that was the first recorded instance of a call option. I'm not sure whether it was called a call option at that point of time, but that's exactly how a call option works. Okay, so Apu gets this. All right, the next one. And this is actually the last question. So guys, pay attention. Where was the world's first stock exchange located? In which city was the world's first stock exchange? I need the name of the city. Okay, boom, Sharon. Sorry, here, actually, even though Sebastian, you said Dutch, Ellie said Holland, but I need the name of the city, you know. So Amsterdam is the correct answer, but let's do one thing. Let's give 5 points to Sebastian. At least, he mentioned Dutch, so, let's give him 5 points. All righty. So yeah, Sharon gets Amsterdam, so she gets the 10 points. So Fan Liang, the scores.
Yep. So we have 2 people tied at the top.
Oh, really?
At 30 points.
Okay, who are they?
With Sharon catching up to Andre, so 2 of them got 30 points.
Fantastic.
And then following them, there are 3 people who all got 15 points. So Perlin, KM, and Sebastian.
Okay, well done, guys. Well done. So Sharon and Andreas, so you are the proud owners. So what we will do is, if you can send your address, the postal address, and we will send your winnings. What we will do is, offline, one of us will get in touch with you. Maybe, Falia, if you can coordinate with them. So we will send you the, the books to choose from. I'm not sure whether you already, read one of these books. So you can pick one and from these books. Basically, today, Saurabh Mukherjea's books. So you pick one, Sharon and Andre, you pick one, and we will courier the books to you. So congratulations, well done. And I hope you guys enjoyed the session. I hope you learned something. And, I know, most of you, I think almost all of you are, I don't know whether you have ever visited India, but over the last 2 decades, these 20 top companies that Saurabh mentioned have been amazing compounders. They have, almost all of them have become 100 baggers. And as he rightly said, that, a country which is growing, which has a young population, and while I won't even bother looking at the other companies, but these companies, extremely high standards of corporate governance. You already heard the kind of return on capital these companies generate. So while this is not a recommendation, but you might want to look at this market, through whatever route, be it through a fund or be it through whatever. In fact, maybe read about Saurabh's fund. They regularly conduct webinars. I think over the next decade or two, there is serious money that's there to be made. Okay, all right, guys, and with that we come to the end of the session. Thank you very much for attending. I hope you guys enjoyed, and we promise to bring you more such interesting sessions with external guests, and also such quiz questions. Thank you very much. Have a great day.
If you found this video interesting, then you should definitely join our research platform. It's completely free to join. There are no hidden costs. And that's where we publish our free research on several high quality businesses, which are typically compounders. The link to join is available in the description section below. And I also welcome you to join our Facebook group called the Investment Forum. That's a place where we discuss these high quality businesses with several other DIY serious investors. And you will benefit from the discussion, I'm pretty sure. And if you enjoyed this video, can I please request you to hit the like button and do subscribe to our channel. It does not cost you a penny, but it'll really help us with the YouTube algorithm. And we will be able to notify you whenever we are coming up with other interesting videos on company research or other investment concepts. So I'll see you in the next video. Thank you very much for your time.